Right now, an index fund somewhere owns Apple. Not because anyone decided Apple is a good buy today, but because Apple is in the index. So the fund holds it. Full stop. If Apple's price doubled overnight, for no reason at all, that fund wouldn't blink. Every new dollar coming in would calmly buy even more of it at a higher price, because the rules now say Apple is a bigger slice of the market. It never asks whether the price makes any sense. That's what an index fund does. By design, it copies the price the market already set. And today, more than half the money in US stock funds works exactly that way. So here's a fair question, a real one. If more and more money just copies the price, who is left to set it in the first place? That job has a name. It's called price discovery. And somebody has to do it. Now push it further. If the people who do that work keep disappearing, does the market slowly stop working? That's the big fear. And underneath it, a smaller, more personal one. When you buy the index and get a fair price for free, are you a freeloader living off everyone else's work? I went looking for the answer to both. One of them genuinely surprised me. But we start with the half you can't dodge. Yes, when you buy an index fund, you are copying. So, who actually sets that price? A stock's price is just the number where buyers and sellers agree, right this second. And it moves because someone does the work to move it. Those someones are the active investors, hedge funds, analysts, professional traders, people who spend all day and serious money fighting over what a company is really worth. And the work is not glamorous. Right now, somewhere, an analyst is on page 200 of a financial filing. A fund is paying for satellite photos of a retailer's parking lots, literally counting the cars, trying to guess this quarter's sales before anyone else. A trader is betting real money that the market has one company priced at 10% too high. That is price discovery. Thousands of people grinding, competing, and where all that fighting finally settles is the price you and I pay. The index fund does none of it. It has no opinion. It just accepts the number they landed on for every company, every day. And hold on to one fact for later. Those same active investors are the people who, on average, lose to the index. Now, the fear assumes those price setters keep quitting until there's no one left. But something stops that. And it's just self-interest. The fewer people doing real research, the more mistakes slip through. And I mean real mistakes. A solid company can quietly trade for less than the cash sitting in its own bank account. It happens, while almost no one is looking. That is exactly when looking pays the most. Whoever is still doing the work spots the mistake everyone else missed, buys it up, and makes a fortune off it. Picture a gold field. The fewer people left digging, the more gold there is for each one who stays. So the emptier it gets, the harder someone gets pulled back in. Everyone just buys the index is self-defeating. It cannot actually happen. Two economists proved this back in 1980. It's called the Grossman-Stiglitz paradox. A perfectly efficient market where every price is already correct can't exist, because if it were, no one would bother paying to dig up new information, and the prices would drift wrong again. A market has to stay a little bit wrong, just enough to pay the people who keep it honest. Now, that's a claim about the balance. It is not a promise about any exact level. And that gap is the whole problem in about a minute. So how far along are we? Right now. Here's the number that should worry you. Index funds were invented in the 1970s, and for 50 years, the people doing the work always held more money than the people copying. Always. At the end of 2023, That flipped. For the first time in history. Quietly. No headline, no alarm. By the end of 2025, index funds held more than 55% of all the money in US funds. More than half of it now just copies. But owning is not the same as pricing. And here's the number that flips the whole fear on its head. Index funds hold more than half the money, but they're only about 5% of the trading that actually happens each day. Think about what that means. On a normal day, out of every $21 changing hands in the market, only about 1 comes from an index fund. The other 20 are the people still fighting over the price. So the buying and selling that actually moves prices every single day is still overwhelmingly them. Index funds own more and more of the market and barely touch the price. And remember the loop. The emptier it gets, the more each remaining price setter gets paid. So there's a floor under this. The floor is greed. Now, the strongest case against everything I've said. And I'd rather say it myself than have you find it in the comments. Maybe the room is already too empty. More than $100 billion flow into index funds every year. And that money buys every stock in the index without ever asking the price. And it can move markets in ways that have nothing to do with value. When Tesla joined the S&P 500 in December 2020, the biggest company ever added, index funds had to buy roughly $70 billion of it in a matter of days. Not because anyone judged it a good price, because the rules said so. And it feeds on itself. Index money flows in by size. So the biggest companies get the most buying. For being big, not for being good. Now, in fairness to my own case, you may have heard that stocks pop just for being added to an index. They used to, about 8%, back in the 90s. Today that pop is basically gone. Traders learn to front-run it, which is price discovery doing its job. So the real worry isn't the pop. It's the forced price-blind buying, piling into fewer and fewer names. And here's the part I honestly cannot get around. How much active money is enough? How empty can it get before the prices stop meaning anything? Nobody knows. There is no number. I went looking for it, and the honest answer from the research is that it hasn't been found. There's no agreed threshold at all, not even close, and that's the unsettling part. There's no alarm that rings the morning price discovery breaks, no headline. It would just quietly stop working, and we'd find out later in the wreckage. So I can't stand here and promise you we're safely on the right side of some line. I can't. What I can tell you is smaller, and it's true. The free ride is real. But the toll is paid by people who are trying to beat the market, and mostly losing. You're not freeloading off a genius. You're freeloading off a very expensive contest that usually loses money. So, are you a freeloader? Yeah, you copied your way to a fair price. But here's the strange part, and the numbers actually show it. The people who did all the work, on average, they did worse than you, because the work cost them time and money, and mostly they were just competing with each other. So you didn't just copy, you copied, and you beat the people you copied from. That sounds almost unfair. It kind of is. But it only holds as long as some of them keep doing the work, and they always will, because the day everyone quits is the day it pays to come back. So don't feel guilty, but maybe feel a little humble. You're getting a fair price for free, because someone else is still paying to figure out what fair is.